I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another financial news cycle that will be forgotten by next week. This is about a structural breakdown happening right now in a part of the financial system that most people don't even know exists. I'm talking about the shadow banking sector. And in the last 72 hours, we've seen liquidity stress indicators that haven't appeared at these levels since March 2020. And before that, September 2008, the overnight repurchase agreement market, the repo market, just showed a spike in rates that suggests major financial institutions are scrambling for short-term funding. At the same time, money market fund outflows hit levels we haven't seen in over 2 years, and the commercial paper market, the lifeblood of corporate short-term financing, is showing signs of seizure. This is not a crash. This is not panic in the streets. This is something more dangerous. This is the quiet mechanism of systemic stress activating in real time, and Wall Street is doing everything in its power to keep this out of the headlines until positions can be unwound and risk can be transferred. By the end of this video, you're going to understand exactly what shadow banks are, why their collapse would make 2008 look like a warning shot, and most importantly, the 3 asymmetric plays you need to position in right now while there's still time. This is not about fear. This is about pattern recognition, historical precedent, and acting before the herd realizes what's happening. So turn off the distractions, grab a notepad, and let's break down the single most important financial story that nobody is talking about. Before we get into the current crisis, I need to give you a framework that will make everything else click into place. Most people think the financial system is just banks, stock markets, and maybe some hedge funds. But the reality is that over 50% of all lending and credit creation in the developed world happens outside the traditional banking system. This parallel universe is called shadow banking, and it includes money market funds, hedge funds, private equity firms, insurance companies, pension funds, and special purpose vehicles that engage in bank-like activities without being subject to bank-like regulation. Here's why this matters. Traditional banks are regulated. They have capital requirements. They're subject to stress tests. They have access to the Federal Reserve's discount window in a crisis, and they have deposit insurance. Shadow banks have none of that. They operate with massive leverage, often 20-to-1 or higher. They fund themselves in short-term markets that can freeze instantly, and when they get into trouble, there's no official safety net. The asymmetry here is brutal. Shadow banks get all the upside of leverage and risk-taking during good times. But when things go wrong, the contagion spreads to the entire system, because these institutions are interconnected with traditional banks, with pension funds, with corporate treasuries, and with sovereign wealth funds. The Financial Stability Board estimates that the global shadow banking system now holds over $200 trillion in assets. To put that in perspective, that's more than twice the size of global GDP, and the vast majority of this is funded through short-term debt that has to be rolled over constantly. If confidence breaks, if liquidity dries up, if counterparties start refusing to lend overnight, the whole structure collapses in days, not months. The thesis of this video is simple but critical. We are witnessing early-stage liquidity stress in the shadow banking system, driven by rising real interest rates, a global debt overhang that cannot be serviced at current borrowing costs, and a regulatory framework that is still designed to fight the last crisis, not the next one. This stress will create 3 distinct phases. First, quiet deleveraging, where institutions try to reduce risk without alarming the market. Second, forced liquidations, where asset sales accelerate and price discovery breaks down. And third, systemic contagion, where the traditional banking system gets pulled into the vortex. We are currently in phase 1. The signals are visible if you know where to look, but the mainstream narrative hasn't caught up yet, and that creates a window of opportunity for those who understand the mechanics and position accordingly. Let me take you back to 2 historical moments that will show you exactly how this pattern plays out. Because what we're seeing today is not new. It's a replay of a script that's been run twice in the last century, and both times it ended in wealth destruction for the unprepared and generational wealth creation for those who saw it coming. The first parallel is 1929 to 1933, the Great Depression. Everyone remembers the stock market crash, but the real systemic devastation came from the collapse of the shadow banking system of that era. In the 1920s, most lending was done not by traditional banks, but by investment trusts, holding companies, and broker-dealers who operated with extreme leverage. These institutions borrowed short-term money to fund long-term investments in stocks, real estate, and corporate bonds. When the stock market crashed in October 1929, the value of their collateral collapsed, but their debts remained. Lenders refused to roll over the short-term funding. Margin calls cascaded through the system, and within months, hundreds of these shadow banks simply ceased to exist. The contagion spread to traditional banks because they had lent money to these investment trusts and holding companies. When the shadow banks defaulted, the traditional banks took losses, which triggered bank runs, which caused more failures. Between 1930 and 1933, over 9,000 banks failed in the United States, and the money supply contracted by 30%. This was a deflationary collapse driven not by a stock market crash, but by the disintegration of the credit mechanism. Here's the critical insight. The investors who preserved wealth during this period were the ones who moved out of financial assets and into hard assets before the full collapse became obvious. They sold stocks and bonds in early 1930 when prices had fallen, but before the real devastation hit. They bought gold, farmland, and distressed real assets at Depression-era prices. And when the government revalued gold from $20.67 to $35 per ounce in 1934, they saw a 69% gain in purchasing power, while everyone else was underwater. The second historical parallel is 2007 to 2008, and this one should be seared into your memory because it was the first modern shadow banking collapse. These institutions borrowed short-term money in the repo market and the commercial paper market to fund long-term illiquid assets like subprime mortgages. The leverage was extreme, often 30-to-1 or higher, and the whole structure was based on the assumption that housing prices would never fall nationwide. When that assumption broke in 2006 and 2007, the shadow banking system started to crack. Bear Stearns ran two hedge funds that collapsed in July 2007. Northern Rock in the UK experienced a bank run in September 2007. But the real systemic event came in 2008. In March, Bear Stearns itself collapsed and had to be rescued by J.P. Morgan with Federal Reserve backing. In September, Lehman Brothers filed for bankruptcy and the entire repo market froze. Institutions that relied on overnight funding to stay alive suddenly couldn't borrow at any price. Money market funds broke the buck, meaning they couldn't return a dollar for every dollar invested. And the commercial paper market, which funds corporate payroll and inventory, seized completely. This was not a banking crisis in the traditional sense. This was a shadow banking crisis that pulled the traditional banks into the abyss because they were interconnected through derivatives, through repo agreements, and through direct lending. The Federal Reserve had to create entirely new lending facilities. The term auction facility, the primary dealer credit facility, the commercial paper funding facility, just to keep the system from imploding. And even with all of that, global credit markets were frozen for months. Here's the lesson from 2008 that applies directly to today. The collapse didn't start with a headline. It started with quiet stress in funding markets. Repo rates spiked. Commercial paper issuance slowed. Money market funds saw outflows. These were the early warnings, and they appeared months before the mainstream media caught on. The investors who acted on those early warnings, who sold overvalued assets, who moved into cash and gold, who positioned for volatility, were the ones who not only survived but thrived. They bought distressed assets in late 2008 and early 2009 at generational lows and rode the recovery for a decade. The investors who ignored the warnings, who believed the narrative that everything was fine, who stayed fully invested in a system that was breaking, they watched 50% of their wealth evaporate in months. Now, let's bring this into the present moment and talk about what's happening right now in the shadow banking system because the parallels are undeniable and the stress indicators are flashing red. The overnight repo market is the plumbing of the financial system. It's where banks, hedge funds, and other institutions go to borrow cash for 24 hours using securities as collateral. In a healthy market, repo rates trade very close to the Federal Reserve's policy rate, usually within a few basis points. But in the last 72 hours, we've seen repo rates spike to levels that indicate stress. Specifically, the spread between the secured overnight financing rate and the Federal Reserve's target has widened significantly. This tells us that some institutions are willing to pay a premium for overnight cash, which means they're having trouble accessing funding through normal channels. This is the same pattern we saw in September 2019 when the repo market briefly seized and the Fed had to intervene with emergency liquidity injections. It's the same pattern we saw in March 2020 at the onset of the pandemic when the entire financial system was on the verge of a liquidity crisis. At the same time, money market fund outflows have accelerated. In the past 2 weeks, investors have pulled over $150 billion out of money market funds, which are supposed to be the safest, most liquid investment vehicles in the world. Why would investors pull money out of funds that yield 4% to 5% in a risk-free environment? There are only two reasons. Either they need the cash for operational purposes because they're facing their own liquidity stress, or they've lost confidence in the stability of these funds and they're moving to even safer alternatives like direct treasury bills or physical cash. Either way, this is a warning signal. Money market funds are a critical source of short-term funding for corporations and financial institutions. When money flows out of these funds, it reduces the supply of credit in the commercial paper market and the repo market, which tightens financial conditions across the entire system. Speaking of commercial paper, this is where the stress is most visible. Commercial paper is short-term unsecured debt issued by corporations to fund their day-to-day operations, things like payroll, inventory, and accounts receivable. It's typically issued for 30 to 90 days, and it's supposed to be a low-risk, high-liquidity market. But over the last month, we've seen issuance decline sharply. The total amount of commercial paper outstanding has dropped by over $80 billion, which is the largest decline outside of recession periods. At the same time, the spread between commercial paper rates and treasury bill rates has widened, meaning that investors are demanding higher compensation for the risk of lending to corporations even for just 30 days. This is a classic sign that confidence is eroding. When investors start to worry about counterparty risk, when they start to question whether a corporation or a financial institution will be able to pay them back in 30 days, they either demand a much higher rate or they simply refuse to lend. And when that happens, the commercial paper market freezes, and companies that rely on this funding to meet their obligations suddenly find themselves in a cash crunch. Now let's talk about why this is happening, because the mechanics matter more than the headlines. The root cause is the same as it was in 1929 and 2008. Excessive leverage built up during a period of artificially low interest rates, combined with a sudden shift to a higher rate environment that makes that leverage unsustainable. For over a decade after the 2008 crisis, interest rates were effectively zero. Central banks engaged in quantitative easing, buying trillions of dollars of bonds to suppress yields and flood the system with liquidity. In that environment, leverage was not just profitable, it was almost mandatory. If you could borrow at 1% and invest in anything yielding 3% or 4%, you could generate returns that looked impressive on paper. Shadow banks, hedge funds, private equity firms, and even corporate treasuries did exactly this. They levered up. They borrowed short-term to fund long-term investments, and they assumed that cheap funding would always be available. But starting in 2022, the Federal Reserve and other central banks began raising rates aggressively to combat inflation. The federal funds rate went from 0 to over 5% in less than 18 months, the fastest tightening cycle in modern history. And here's the problem. All of that leverage that was built at zero rates now has to be serviced at 5% rates. The cost of rolling over short-term debt has quintupled. For institutions that were operating with thin margins, this is a death sentence. They can't earn enough on their assets to cover the cost of their liabilities. And when their short-term debt matures, they have to either refinance at punitive rates or liquidate assets to pay off the debt. This is the quiet deleveraging phase, and it's happening right now across the shadow banking sector. Hedge funds are reducing risk. Private equity firms are struggling to exit investments because the IPO and M&A markets are frozen. Insurance companies and pension funds are realizing that their liability structures don't match their asset returns. And all of this creates selling pressure in financial markets, which drives asset prices lower, which makes the leverage problem even worse. But there's a second layer to this that makes it even more dangerous, and it's something most people don't understand. The shadow banking system is built on a foundation of collateral rehypothecation. Let me explain what this means. When you borrow money in the repo market, you post collateral, usually treasury bonds or high-grade corporate bonds. The lender takes that collateral and can then use it as collateral to borrow from someone else. And that third party can use it again to borrow from a fourth party. The same piece of collateral gets reused multiple times throughout the system. This works fine when everyone is confident and markets are liquid. But when stress appears, when people start questioning the value of the collateral or the creditworthiness of the counterparties, the whole chain breaks. If one institution defaults and can't return the collateral, everyone downstream is suddenly exposed. This is what happened with Lehman Brothers in 2008. They were a massive player in the repo market, and when they filed for bankruptcy, billions of dollars of collateral was trapped in the bankruptcy proceedings. Counterparties who thought they were fully secured suddenly realized they had unsecured claims in a bankruptcy, and the panic spread instantly. Right now, we're seeing early signs that collateral chains are under stress. The amount of Treasury collateral being posted in the repo market has increased, which sounds good until you realize it means that institutions are having to post more and higher quality collateral to borrow the same amount of money. This is a sign that lenders are getting nervous. They're demanding more protection, more margin, more assurance that they'll get their money back. And when that dynamic takes hold, it becomes self-reinforcing. More collateral demand means less liquidity, which means more stress, which means even higher collateral demands. We've also seen a troubling pattern in the derivatives market. The Bank for International Settlements reported that notional derivatives exposure in the banking system now exceeds $600 trillion globally. These derivatives, interest rate swaps, credit default swaps, currency forwards, they all rely on the assumption that counterparties will be there to make good on their obligations. But in a shadow banking collapse, counterparty risk explodes. The same institutions that are scrambling for overnight funding in the repo market are also sitting on massive derivative books. If one major player goes down, the derivatives exposure cascades through the system, just like it did when AIG collapsed in 2008 and had to be bailed out with $182 billion in taxpayer money because the entire financial system had sold credit protection to them. There's another critical element that makes this moment more dangerous than 2008, and it's the concentration of risk in a smaller number of institutions. After the 2008 crisis, regulators forced smaller banks to merge with larger ones in the name of stability. The too-big-to-fail banks got even bigger. Today, just 4 banks, J.P. Morgan Chase, Bank of America, Krupp, and Wells Fargo, hold over 40% of all banking assets in the United States, and these same institutions are deeply embedded in the shadow banking system through their prime brokerage operations, their asset management divisions, and their trading desks. If stress and shadow banking forces one of these institutions into trouble, there is no easy resolution. They are so large and so interconnected that their failure would immediately freeze global credit markets. The Federal Reserve knows this, which is why they will do everything possible to prevent an outright failure. But prevention requires liquidity injections, bailouts, and monetary expansion. Which brings us right back to the asymmetric investment framework. If the Fed has to choose between allowing a deflationary collapse or inflating the system to prevent it, they will choose inflation every single time. This is the lesson of every financial crisis in the modern era. Now let's connect this to the 3 asymmetric plays that make sense in this environment, because understanding the problem is only half the equation. The action you take in the next few weeks will determine whether you're positioned on the right side of what's coming. The first asymmetric play is U.S. Treasury bills and short-duration government bonds. I know this sounds boring. I know it doesn't have the excitement of trading volatility or speculating on distressed assets. But in a shadow banking collapse, liquidity is king. When funding markets freeze, when counterparty risk explodes, when institutions are scrambling for cash, the only assets that maintain their value and their liquidity are direct obligations of the U.S. government. Treasury bills are the collateral of last resort. They're what the Federal Reserve accepts in the repo market. They're what money market funds are rotating into. And in a crisis, they're the asset that everyone wants and no one is willing to sell at a discount. The asymmetry here is that your downside is capped at slightly below inflation returns, but your upside is massive optionality and purchasing power preservation when everything else is being liquidated. If the shadow banking system seizes and the Fed has to cut rates and restart quantitative easing, Treasury bonds will rally hard and you'll be sitting in the asset that benefits most. You can buy Treasury bills directly through Treasury Direct with no fees, no intermediaries, and no counterparty risk. This is the safest place to park liquidity while the storm develops. The second asymmetric play is physical gold and silver, and I cannot emphasize this enough. In a shadow banking collapse, the entire financial system's credibility comes into question. Repo markets freeze, commercial paper markets seize, and suddenly the institutions that everyone thought were safe are revealed to be over-leveraged and undercapitalized. In that environment, the flight to safety isn't just into government bonds. It's into assets that have zero counterparty risk, that can't be rehypothecated, and that have been recognized as money for 5,000 years. Gold and silver are the ultimate systemic hedge. They exist outside the financial system. They can't be printed, they can't be diluted, and they can't be trapped in a bankruptcy proceeding. When the shadow banking system collapsed in 2008, gold went from $800 an ounce to over $11,900 by 2011. That's not because gold became more valuable. It's because the dollar and the financial system became less trustworthy. We're setting up for the same dynamic now, except the debt levels are higher, the leverage is greater, and the central banks have fewer tools to respond. If you don't have at least 10% to 20% of your portfolio in physical precious metals stored outside the banking system, you are taking on uncompensated systemic risk. I'm not talking about paper gold ETFs or unallocated accounts at banks. I'm talking about physical coins and bars that you either hold yourself or store in a fully allocated segregated vault where you have direct title to specific bars with serial numbers. In a systemic crisis, the difference between paper claims and physical possession is the difference between having wealth and having a lawsuit. The third asymmetric play is volatility positioning through options and tail risk hedging strategies. When shadow banking stress escalates into forced liquidations and systemic contagion, volatility explodes. The VIX, the measure of stock market volatility, typically trades in the 12 to 20 range during calm periods, but in 2008, it spiked to 80. In March 2020, it hit 85. When the market realizes that a shadow banking collapse is underway, implied volatility will gap higher instantly, and options that were cheap insurance will become extremely valuable. The play here is to buy out of the money put options on major indices or to implement spread strategies that profit from volatility expansion. The asymmetry is that you're risking a small premium for potential returns of 10 to 1 or more if the collapse accelerates. This is not a speculation. This is a hedge. If the system stabilizes and the stress dissipates, you lose the premium, which should be a small percentage of your portfolio. But if the shadow banking system seizes, those options become a lifeline that offsets losses elsewhere and gives you dry powder to buy assets at distressed prices. Right now, with implied volatility still relatively low, this insurance is cheap. Once the market starts pricing in systemic risk, the cost of protection will skyrocket and the window will close. Now let's talk about what you need to do immediately because the window for positioning is closing faster than most people realize. First, you need to assess your exposure to shadow banking risk. If you hold investments in high-yield bond funds, leverage loan funds, or structured credit products, you need to understand that these are directly exposed to the stress we're discussing. These funds rely on liquid markets to function, and when liquidity disappears, they can't meet redemptions. You saw this in March 2020 when high-yield ETFs traded at massive discounts to their net asset value because there were no bids for the underlying bonds. If you're sitting in these positions now, you're taking on tail risk without being compensated for it. The prudent move is to reduce or eliminate exposure to these areas and rotate into higher quality, more liquid assets. Second, you need to check your cash allocation and where it's held. If you have significant cash in money market funds, you need to verify that those funds are invested in government securities, not commercial paper or repo agreements. The safest money market funds are government-owned funds that hold nothing but treasury bills and repurchase agreements backed by treasuries. If your fund holds corporate, commercial paper, or bank certificates of deposit, you have exposure to exactly the institutions that are under stress right now. Move that money into government-only funds or directly into treasury bills through Treasury Direct. This is a simple step that eliminates counterparty risk and ensures your cash is actually safe. Third, you need to establish a position in physical precious metals if you haven't already. This is not a trade. This is insurance. I recommend allocating 15% to 25% of your investable assets to physical gold and silver, stored either in your possession or in fully allocated segregated vaults outside the banking system. Work with reputable dealers who have been in business for decades. Verify the authenticity of what you're buying and make sure you have a secure storage solution. Avoid paper gold like ETFs or unallocated accounts because in a systemic crisis, there's no guarantee you'll be able to convert those paper claims into physical metal. The time to buy insurance is before the fire, not after. Fourth, you need to build liquidity and reduce leverage in your own portfolio. If you're using margin or leverage to amplify returns, now is the time to dial that back. In a forced liquidation environment, margin calls cascade, and even good assets get sold at terrible prices because there are no bids. The investors who survive and thrive in these periods are the ones who have cash, who have no forced sellers above them, and who can be patient while others panic. Liquidity gives you optionality. It allows you to buy distressed assets when they hit the market at fire sale prices. But you can only do that if you're not being forced to sell your own positions to meet obligations. Fifth, you need to set up volatility hedges if you understand option strategies. If you don't, find an advisor who does or educate yourself quickly because the opportunity to buy cheap insurance doesn't last long. Once the market starts to price in systemic risk, implied volatility spikes, and the hedges become expensive. Right now, with the VIX still below 20, put options are relatively cheap, and that's the time to establish the position. Think of this as paying for fire insurance on your house. You hope you never need it, but if the fire happens, it's the difference between financial survival and total loss. Here's the question I want you to answer in the comments, because I genuinely want to hear where this community stands. Do you believe the stress we're seeing in shadow banking right now is a temporary blip that will be smoothed over by central bank intervention? Or do you think this is the early stage of a systemic event that will escalate in the coming months? I want real perspectives, not just agreement. Tell me where you see this going and what you're doing to position for it. The collective intelligence of this community is one of its greatest assets, and I learn as much from your insights as you hopefully learn from mine.